Chamath, what do you take from all of this crazy high growth GDP? Is this because of stimulus, government spending? What is this confounding, inflation coming down and getting somewhat under control and then crazy GDP growth?
I don't know. I don't think anybody knows. But it's really confounding for the markets. I think it's really bad for markets in general. It's probably the worst for private companies because you have this effect now where everybody's been wanting to price in a recession, right? Everybody wants to see that shoe drop where they say, oh, okay, here it is. Something's softening. Demand is softening. And then when you see a print like this where the economy is expanding, you're kind of confused and you're like, well, where is this softening going to come from? And so what happens is people become very overreactive to small amounts of data. And that actually started to come out, I think, basically since August. And what's been happening since August is that every time a company reports, the sector that's gotten the most attention has been fintechs. And the reason is that fintechs tend to be on the bleeding edge of capturing consumer demand. And if consumer demand shrinks, that's probably the first sign that there's going to be a recession, right? Because consumption is about almost 70% of the US economy. And so since August, what you've seen are the large leading edge public fintech companies just get absolutely murdered. And yesterday was an even worse day because what happened yesterday was a company was basically Worldline started to report softness in spending. Now, that spending was not even in America. That spending actually happened to be within a segment of their customer base in Germany. And that was enough to just literally sink the stock, I think 60% in a day. So we have on the surface a healthy growing economy, but underneath the surface, what we are betting on increasingly is that consumer demand has basically stopped. So you can see here, Adyen is down 50% since the beginning of the year. But again, most of this was since August. Block is down another 35%. PayPal is down 30%. So that's one thing, which is this is a big bet that consumption is slowing and shrinking. The economy will be in a recession over these next 2 or 3 quarters, which will give the Fed the motivation and the justification to lower rates starting in the middle of next year. That's the big bet in the market. But separately, if you take a different lens and look at this data, we all have a bigger problem in Silicon Valley land, which is how do the capital markets take companies public when this is happening? And the reason why this data is so important is we've said this 1,000 times. There are only 2 companies that can structurally open the capital markets for all startups. One is SpaceX Starlink, but that's on its own path and not going public soon. And the other is Stripe. And
you could probably add TikTok to that as well. Yeah.
No, because that's a Chinese company with all kinds of overhang. So no, I would disagree with that.
But with 30 or 40% US ownership.
I would disagree with that. But no.
Okay.
So I think it's Starlink and Stripe. And the problem now for Stripe is that the public comps dollar for dollar are off 50%, which from the beginning of the year, which then says that if you apply that ratably to its valuation, they did around at 55 billion, then the market clearing trade may be 25 to 30 billion now. Now, 25 to 30 billion for Stripe, you're incinerating $70 billion of equity value, right? And about $5 to $10 billion of actually paid in capital. So what does that do for Silicon Valley and for VCs? I think it's going to put a lot of pressure on companies and valuations. So yeah, we're in for a real slog. So on the surface for the real economy, I think it's generally decent news. For startup land, I think it's not good. And then specifically within startup land, sectors like fintech are in pretty bad trouble, I think.
And the late stage, obviously, still very much in trouble. Freeberg, any thoughts on the startup economy? You had some thoughts on this, I think, too.
I'd like to hear your guys' experiences, but there's definitely been a big holdup in Series B, C, D later rounds because so much of the market questioning is, when is the next round going to get done, which is based on when can the companies potentially go public. And ultimately, if you don't see a path to a window opening up, you don't fund the pre-IPO round, you don't fund the late stage round, the growth stage round, everything gets held up. And a lot of rounds that are getting done lately have been these kind of convert or bridge rounds where existing investors are funding the company to give it another year or two of runway. That was definitely the case for most of this year coming out of 22. I think post the summer, it seems like a lot of folks I'm talking to are starting to wake up. There's even more Series B at lower prices, and everyone's kind of capitulating and accepting that there are still great businesses out there. It's just that they got overpriced in their A or their B, and let's price them at a lower valuation. And rounds are sort of starting to get done in the fall here.
I'll have you react to this data, Sachs. Carta manages cap tables for folks, but they have produced this chart, and this is Carta companies only. So this is a subsection. Who knows? Carta may power the cap tables of 10%, 20% of Silicon Valley. The rest are done on other pieces of software or even in Google Sheets or literally in an Excel sheet by an attorney who is working with the company. If you look at this chart in 2020 and 2021, you had about 70 startups shutting down per quarter. In 2022, you see that number double, and we start seeing 129, 141 a quarter. And then in 2023, this last quarter, Q3, rocketing up to 2020. So roughly 3 times what we see in the boom markets. Sachs, and any thoughts on this data? I have a couple of observations, but I wanted to go to you first.
Well, this is not surprising to me at all. This is the bubble of 2021 working its way through the system. We know that there were these gigantic rounds that were funded in 2021, especially in the second half, where you had this asset super bubble. It wasn't just in tech. It was like all growth stocks, crypto, everything. And so there were a lot of startups that raised huge funding rounds at the peak of the market, and they haven't had to raise for a couple of years. Well, now they're starting to run out of cash, and they do have to raise. They're finally being forced to go back into market. And a lot of them are either burning too much money or they don't have the numbers to justify another round. Or if they do, it's a structured round, a down round. Or again, they just are unable to raise. They have a broken process and they eventually start winding down. So I think you're going to see this dynamic for the next 18 months or so. But this is not a new dynamic. This is the lagging indicator of what we've been talking about since the regime change of the first half of 2022, is that the markets started looking for different things instead of growth at all costs. It's been about growth with unit economics and efficiency. And the valuations went way down. And there's a lot of companies that no longer qualify and they're getting weeded out. So this is just a delayed reaction to things we already knew.
That's the key part, the delayed reaction as well. I'll just note when a company does shut down, that process typically takes 2 or 3 quarters. And for a founder to accept the shutdown, that might take 1, 2, 3 quarters as well. So anything you're seeing in 2023, that might be a shutdown where the employees were all laid off in late 2022.
But I mean, I have a question for you guys. What turns this around?
I'll tell you what I'm seeing in the early stage. We are seeing many companies come to Founder University and 2 or 3 people who want to build a company who can't get jobs at Google or Stripe. They're not hiring. So we'll see 2 or 3 developer teams working on a project and then raising $250,000, $500K at a $5 to $12 million valuation, and then very quickly getting to $10 to $50K in monthly revenue.
But what about all this money that we need to return so that we can recycle and keep doing this job? What needs to happen, Sachs, Friedberg? What do you guys think needs to happen to crack? Because like the 3 IPOs we've had have not fared particularly well. And the market just seems to get harder and harder for tech companies, even profitable ones, right?
So, yeah, I mean, I think profitability is key. I think that's the great evolutionary forcing function here. It's like a tale of two startups. The one startup needs cash for a long period of time, and the other one's found a path to profitability. The one that's found a path to profitability, they have an infinite number of options available to them. It might take longer to get public or whatever, but they can wait it out because they don't need money. The one that needs cash continuously and will for a long period of time, it's really screwed.
What about the multiple of these profitable companies? That seems to have changed materially as well.
I'll tell you something that's starting to happen as well, Chamath, is that the public markets are looking at their stocks if they're undervalued. And then Dara at Uber is reportedly planning like buying back upwards of 20% of the Uber shares in the next 5 years. And then you look at a company like Snap, which is majority control with super voting shares, they're still losing 300 or 400 million a quarter. So I think Friedberg's exactly right.